Welcome to the XY Advisor Podcast, a global community of financial advisors sharing and learning with one another to drive the positive evolution of financial advice. To get involved, go to xyadvisor.com or simply download the XY Advisor app.
Innova Asset Management is a boutique portfolio manager that has been managing client portfolios since 2010. Innova believe in constructing portfolios that work with investor behaviour rather than against it. This is why they have built risk-focused portfolio solutions that support a goals-based advice framework. Innova's focus on risk management and their active approach to asset allocation has been designed to work through all market cycles, which was evident in 2020 when they were able to participate in the market rebound while also protecting capital on the downside.
Hello and welcome to this topic series on behavioural investing, where we're taking a deep dive into the client and advisor decision-making process. My name is Fraser Jack, and in this episode number 2 of 5, we cover goals-based investing. From the advisor discussions with clients to how fund managers can take on a goals-based approach. If you've ever thought about having these types of conversations with your clients, then this episode is a must. Welcome back to episode 2 in this series. I'm joined by Patricia and Catherine, and in this particular episode we're talking about goals-based investing and goals-based advice in itself. Patricia, we're going to start with you this time. Tell us about what does goals-based advice and goals-based investing mean to you?
Hi, Fraser. It can mean a range of things. I'll start with an easier example, I think, which is what a lot of people are doing these days is the bucket strategy concept. For example, if you sit down with a client and you work out, 5-10 different goals, what you then do is you work out the time frame of those goals. So is that something short term, medium term, or long term? What are their minimum income requirements? What are their wants versus needs. So there's a range of different ways you can go about it. But the idea is that you want to first determine the amount of money that they need and when, and then potentially work backwards from that on the amount of risk that they should take with their portfolio. But it sort of doesn't stop there, because you then have to overlay that with, can they actually withstand this level of risk and volatility where their behavior won't make them do something that could actually lead to a worse outcome. So what I mean by that is you could have a client that only has longer term goals. So technically, you might say that you can invest in a high growth portfolio because they're not going to need the money for 10, 15 years. But then you find out through your discussions with them that they're very risk adverse. And then even after a lot of education, you can tell that if their investments went down in value, even if it was 10, 20%, that they would be very worried and that probably would make the wrong decisions at that point in time and sell when markets are low. So there's a range of different ways you can go about it, but I think this example just highlights the fundamentals behind it. So it's trying to work out the risk tolerance, the risk capacity, and then the different buckets and solutions that might meet that, and trying to overlay one with the other in the best way you can.
Yep. Catherine, what are your thoughts?
I'd like to hear more from Patricia about how you actually overlay that. So the challenge to me seems like you have someone's risk tolerance. That's just their personal, present bias overall, their tolerance for the down movements in their portfolio. But at the same time, you might have a short-term goal, which will end up with a completely different asset allocation to a long-term goal. So from a compliance perspective in particular, but also from a client engagement perspective, how do you actually overlay those two components? And I know this is heavily just focusing on the asset allocation side, but...
Yeah, so there's a couple of ways. I find that not often you find that you have a client that might just have only a short-term goal, for example, and then everything has to be conservative. Like there might be other things that then overall you could overlay that risk tolerance with the different portfolios. But let's keep it simple. Let's say that a client only has a short-term goal, like to buy a property in a year or 2 years. But then the risk profile or, the tolerance is quite high because they're young and they want to invest for the future. Well, that's essentially a conflict. So we explain that to clients and we say, look, you've got a long-term view and you've got the ability to sustain ups and downs. Maybe they've had some experience with shares in the past, but then we explain that you've got this goal and you need, $200,000 to buy a property and you want to save for that for the short term. So my question to you is, if you do invest high growth and that goes down by 30, 40%, are you going to wait longer to buy the property? And if the answer is no, then you explain to them, well, that's why you probably can't invest like that, because you need to be able to sustain that. And then if the question is yes, do you want to do that? Is that more important? Is getting better returns now in the short term more important than getting the house sooner? And you essentially have those discussions and then agree on the strategy going forward. So even though their answers could have been like that, you might then end up having to do a different risk profile. And we go, okay, now answer with that in mind. With that in mind, where the main priority is to buy a house and you're not willing to delay that purchase, how would you answer these questions? And normally that will lead to a different outcome. And then, essentially you just have to deal with the conflicts and work through those conflicts until you get to a solution that is suitable.
Yeah, now, Catherine, I just wanted to throw to you in this particular moment now, because obviously we're talking about if markets drop, you invest and then markets drop. I know you've done some research around this particular thing. Do you want to quickly tell us about the results from that?
Just to clarify, I do a lot of research. Which particular research are you referring to? I
think you did some research around when people, they're purchasing and then going in and then markets dropping. So timing the market is, or trying to time the market with those types of investments.
I see. So I've done research that looks at, in particular, the effect of a geared portfolio compared to a non-geared portfolio. And the idea is it kind of replicates a new client scenario where generally there'll be an initial investment, and it can either be a small investment or a large investment. And the geared question is an interesting question in general, especially for clients with very high risk tolerance. But regardless of the gearing component of that particular research, and we looked at going into the market in every single month since 1976, which is when the data set started. And basically the results of the research is timing is everything. And you can't predict, of course, because the previous few months don't give you any indication of whether the next few years will be a good thing. And of course, a general investment portfolio of, say, a 5-year time frame is quite a long time to invest. So it's all about the sequencing risk. And I'm sure that Patricia has this experience, especially with regards to goal-based investing, where each, component of assets has a different time frame to the other particular components of assets. So the sequencing risk almost becomes magnified in a way, because you might have all of the investments going in at the same time, and then you have them all coming out at the time that's associated with that particular goal. So in particular, say at the point of retirement, which traditionally, as soon as someone reaches retirement, they'll often then convert their assets to more conservative asset classes, which just introduces a huge arbitrary sequencing risk of when you exit the market. So the sequencing risk is at entry and at exit. So that overlays obviously with goals-based investing even more than a traditional kind of one asset bunch approach.
Yeah, that was exactly the conversation I was trying to get to. It's probably a little bit off topic, but I think it's relevant to that particular story that Patricia told. Patricia, I wanted to ask you about the 5 to 10 goals conversation. Now, you mentioned it's fairly simple for you to talk to your clients around having those goals. in the past, it could be the profession could be accused of not finding enough goals for clients. How do you go about, and how do you have any trouble finding a bunch of goals for each particular client?
So essentially, I'll just prompt them with things that I've seen other clients. So I'll give them ideas. I say, some clients might have, some people might want to leave inheritances to their children. Some people might want to go on holidays or take time off work or live overseas or have an education fund for their children or so I'll just essentially give them examples of other goals because that will inspire them. The more you do it, the more they understand it, and then the easier it becomes for them. Like the beginning is the hardest, I think the hardest is actually not finding the goals. The hardest is putting a figure and a time to it. How much do I need for that, or how much do I need for that? That's the hardest part. But to be honest, I think our job is, I think the best thing we can do for clients is to just start with a foundation. I always say to them, let's try to get this as accurate as possible because that will help us manage it along the way. But even if it's inaccurate, we'll change it. That's why we've got an ongoing relationship with you. But we're going to do our best to make it accurate. We're going to, we're not just going to accept that word that they spend $20,000 a year. I know that that's probably unlikely. I will prompt them and I'll do calculations to show them that that's probably not the case, and we'll try to be as accurate as possible. But a lot of the times things don't happen the way that you expect them to happen, and that's okay. The main point is just to be able to have the map there and have the business plan and then adjust the plan as you go. But I think the examples is what helps the most at the beginning.
Yep, excellent. So having a bit of a list or a master list or a conversation that can give them ideas. And I just wanted to quickly ask you too around the bucketing. How are you calculating the bucketing at this point? Are you having to go away and do individual calculations, or have you got tools that you use?
Yeah, there's a range of different ways. So for every client it'll be different, but essentially, again, you work through short, medium, and long-term goals. We do projections and we look at how much we're needing to take out of the different assets at different points in time. And then to sort of add on to what Catherine was saying before about sequencing risk in terms of that time of retirement, moving from growth to moderate or balanced, let's say, to more conservative allocation. Again, we educate clients about that and we say we can't just wait until you retire to do it. We have to actually do it along the way before retirement. So I talk about like retirement risk zone. So, we have to prepare for retirement, or if we're not preparing for retirement, like some clients actually don't want to do it. Some clients have had a lot of experience with growth investments. They don't want to. I then do the calculation. I go, okay, well, every year that we delay, this is the risk. This is what could happen. Are you prepared to delay your retirement? And they usually, in the case, would say, yeah, actually we would. If the market crashed right then, we would delay our retirement because it's more important for us to have a higher growth portfolio now than to go more conservative earlier. So for me, that's why I say to them, that's why it's important. Every year it changes. Those calculations change, and their behaviors will change as they get closer to retirement. They will get more conservative. Majority of them will. And even as they get closer, start going, oh, we'll revisit this next year, right? I'm like, yeah, we'll revisit this next year, or, at our next meeting in 6 months. So they learn that because we preempt that early on. So it's all about, I think, explaining that it's a long-term strategy and then revisiting it every year, and then it becomes ingrained and they know what to expect.
And then how do you go about the investment side of it? Because sometimes, we say goals-based investing, but sometimes it could actually mean goals spending, spending the money, not just investing it. But tell us about your thoughts around that now from the next step of taking the portfolio and investing it.
Yeah. So there's different ways. And again, we'll talk about different ways to invest with them. But there's a range of different calculations and things that we have to go through to make sure it all adds up, that it adds up from the amount that goes into the bucket as well as the overall risk that they're taking. So there's a lot of things that we need to look into. But let's say, to keep it simple, that over the next 10 years, we work out that they're going to need to withdraw this amount from their investments each year. So we essentially might go, okay, so we need 1 or 2 years in cash or 3 to 5 years in conservative, 5 to 7 years in moderate, 7 balanced, and high growth. So you work them with their minimum investment timeframes or recommended investment timeframes. Also taking into account the fact that you get dividends, for example, that top up the cash account and things like that. So there's a range of different things. It's not perfect. I don't have it's something that I think that hopefully Catherine and people like her can actually help us because I think that also markets have changed so significantly. When I started, the minimum time frame that was recommended for some high growth investments might have been 5 or 6 or 7 years. Now it can be 10. Interest rates are much lower. Bonds carry a lot of risk. It's actually, I still feel that we potentially have old tools to address today's problems. Like we don't actually have the tools to address today's problems because we haven't had today's problems before. Record low interest rates and record low bond yields and rising rates and overvalued market. So everything is just, really, there is no safe asset. So again, we explain that to clients, we don't have a bulletproof approach. We just have tools to help us manage and have control when we need to make big decisions.
Catherine, did you want to add anything to that?
It's such a complicated scenario at the moment. And to me, normally it's a complicated scenario for it when you look at goals-based investing because you've got the asset allocation discussion for every single goal, right? So there's no one discussion and one blanket approach. It's a detailed discussion. And then, of course, with the current scenario, as you mentioned, all of the conservative assets are now, even more clearly risky assets, I suppose.
Yeah, I think the danger in that is it starts to become confusing, right?
Mm-hmm.
Yeah, so if a danger of that starts to become confusing, then does that mean that the advice becomes a really long and complicated process?
It can be. At the moment, I don't think that we've made it more confusing because I don't think anyone has the answer to the problems that I've just raised and Catherine, endorsed. Is no one has a solution. What do you use for defensive when defensive isn't truly defensive? So that's really difficult. But we also know that we can't predict what markets do. I think we just need to continue to work on changing the way that we build portfolios and look at markets, continue to learn, but no one has a bulletproof strategy. So as long as clients understand the risks, and we're doing the best job that we can with the tools that we have today, but also I think we need to continue to work on better tools to help with that.
Yeah, I really like the way that you said earlier, we don't quite have the tools to address today's problems because we haven't had today's problems before. So I think that's a really interesting point. Patricia, Catherine, thank you so much for joining us in this episode. I look forward to going a little bit deeper into these conversations when we start tackling values-based decision-making in the next episode. At this point in the conversation, I'm welcoming Dan and David back to the conversation when we're talking about goals-based investing. Dan, I might kick this one off with you. Tell us what your sort of high-level thoughts on goals-based investing are.
I'd like to keep it reasonably simple in that you want to invest your money to achieve it's kind of self-explanatory, right? You invest your money to achieve a goal. Where I think it starts to get a bit nuanced is how do you go about doing that? I'm of the firm belief that people have multiple goals. Even if a client comes to you and says, no, my only goal is to be able to fund my retirement. Well, okay, that might be the case, but you might have another 30 years to live. And so therefore you might have 3 different time horizons. And therefore you may need to look at it in 3 different ways. That you may have 3 different levels of risk tolerance, capacity, and need to take on over those intertemporal periods. And therefore, it's my belief that we should be building portfolios that are based around clients' goals, which I think where we can bring back in the concept of mental accounting and bucketing and saying, okay, well, what are the highest priority and what are the shortest term, and how can we build portfolios that are based around the risk that that you've said that you can tolerate and you have the capacity for to take on for that. Yes, we want to maximize the return, but we don't want to breach that risk. And it's really it's the breaching of that risk is what I think is key in goals-based investing, because it's when clients experience something that they weren't expecting that leads to what is generally value-destructive behaviour. If they go through, we're going to talk about risk profiling later, so I won't go into huge detail here, but, a client has filled out a risk profile questionnaire and they've got a certain score, and let's say they're balanced, and they're put into a portfolio with a fairly static asset allocation. And in theory, the amount of risk that they receive over a very long time horizon should average out at about that. But we know that that's not how markets operate, and that risk changes and is volatile throughout time. But given that the amount of risk that they can tolerate is reasonably fixed, at least at the point in time in which the strategy is set, I think that a goals-based investment should be benchmarked to the amount of risk associated with what it is that they have said that they can tolerate. Because if you breach that, that is when you're going to get these behavioural responses that can be value destructive. There's lots of people that say things like, capital losses don't count unless they're realised and you sell them. Well, look, let's be honest. Human beings, if they see negative things on their screen, it leads to a visceral response that can equate into a behaviour that leads to a realisation of that capital loss, because they were not expecting that result. And so if we can manage portfolios to, fairly strict risk parameters, I think we get a lot closer to what is a goals-based investment than setting it up based around, capital market relative return associated portfolios, which may or may not have anything to do with achieving their goals and what their own personal biases and behaviours can tolerate. Anyway, that's my opinion.
Excellent. I'll get your initial thoughts.
Yeah, sure, Fraser. Dan's really called out some interesting points there. The range of outcomes around the goals when you're designing that framework's really important, and I might get back to that later, but I just wanted to maybe start with the amazingly interesting, difficult, fascinating job that financial advisors have, because here they're trying to marry the theory with how do they frame this and engage with retail clients. It's just an amazingly challenging problem. So, on the academic side, the whole foundations of savings investment is the life cycle model of savings, consumption, investment. It's been around for it's just gone past its 50th anniversary. Merton and Samuelson, both Nobel Prize winners, have framed that up. And it's all about through your whole life, generally smoothing life cycle consumption through time. You then have to add in all the peaks and troughs to that, which is where goals come in. People don't spend the same amount every year. They save up for a nice holiday, or they have school fees for a period of time, and they have all these issues that come through the journey of life. And so if you start with something that's completely theoretical, it's just not going to connect. And if you don't connect, people won't stay the course with a plan, and it all starts to fall apart, because it's actually, in my view, the strength and commitment to that plan, to hold on to it, to work through the ups and downs of that plan, which allows people to stay the distance and realise longer term risk premium as they get realised. So you can start to see the amazing challenges faced by advisors. They have to sort of convert into something that feels more tangible, can relate, get past some of these time horizon effects where it goes from the present to the future. How do you visualise the future? Well, you put some goals there, like here's a picture of European River Cruise in 15 years' time. Here's a picture of my son graduating in 10 years' time where I have no more school fees. Won't that be nice? And all these things which start to come around. And so even though I love the theory of it, I think goals-based is sort of a frame that I understand. I think it's a really neat one for advisors to use as that bridging mechanism. It's how it's applied, which is some of the things which I think Dan's talked to, which is where the rubber hits the road and it does get quite challenging.
Yeah, and I love the word connection that you used just then too, and the client connecting with the plan and connecting with the goals and the outcomes. And I'm a big one, as you mentioned, Dan, for having a lot of goals under advice, or a lot of goals under management. I call them. I actually call it goals under management, and I like the idea of the advisor really getting into that, like getting into that scenario where they're there to achieve the outcomes of the goals, not just to achieve a percentage return or any of the benchmarking we talked about in the previous episode, but understanding and, having a bucket list of things on the goals list. And as you tick some off, you bring others in. And so you're really managing that goal process. But Dan, from a, investment point of view, I think a lot of advisors struggle to then realise or connect that. If I'm having a conversation with the client about their goals and I'm there, to help them bucket those things, how do I then translate that into the investment world? Shouldn't I just be finding a normal investment, or what are your thoughts?
Well, no, I think that's where I think it comes down to understanding and having a greater appreciation and more technical tools to understand the amount of risk that can be associated that the client can take. So that you can, instead of just concentrating on risk tolerance, which is I guess a psychological measure, and you can take on things such as risk capacity, which is an objective measure, and also goal risk, the possibility of achieving those goals. And David, as you said, it's also the sequence of how these things occur throughout time. Everything is path dependent. And, if it's all well and good that you might be in 10 years' time, the top decile performer in something, but if 3 years into it, something occurred that clients were not pre-positioned for or aware of could occur, and they divest away from it, 3 years into the thing, who cares where you are 10 years later, because the client's already left. And so that's where I agree with you. It's this fascinating challenge for advisors to try and translate that back. And my belief is that is the use of some of the new tools that are available to understand, clients' financial literacy. It's to expand upon the understanding of risk, to move beyond just tolerance, but also capacity, onto need, onto the ambiguity around the likelihood of achieving those goals and the prioritization of those goals, and then associating levels of risk with them that they may either need to take on or that they are comfortable to be able to take on, and that portfolio managers provide solutions that fit that framework, so that the client knows why they own what they own, and then unless the portfolio does something that it doesn't say it should do on the box, they really shouldn't worry, because they know why they own what they own and where it's there for. And I think that is going to increase the likelihood that they will stay the course for the long term. And I'm a firm believer that clients are not, most clients, some will, but most clients are not going to achieve their long-term goals unless they have someone like a financial advisor to be able to help them, with everything that goes on in life and all the changes that occur, not just markets, but everything else that goes along as well. That's it. One of our taglines is, returns matter, but behavior matters more. I mean, that's really where the advisor can add so much value.
Yeah, so what I'm hearing you say is a lot of the stuff around managing the risk, even more so than managing the returns, and it's an interesting thought about managing the risk or the conversations that the advisor is having with the client, but then for that to spill over into the investment portfolio, also working with the advisor to manage the risks as well as the returns, I guess.
Yeah, it's exactly right. And if I just take Dan's conversation there, which really was insightful, and just try and nail it down to one specific example. I think of goals as a great framing agent. They really connect the advisor to the client, and then you got to work with those goals to really build out the plan. And you have to think of it, just like Dan was saying, the range of outcomes and the likelihood of achieving those goals, how much you might miss by or exceed by, which is what you sort of, the non-client word would be stochastically thinking about the outcomes and having systems to support that, but getting the right language. And then if you can do that, you're really setting yourself up for a rich plan. So if I just go like the retirement decision and planning for retirement, if you can picture it out a long way out, put the nice picture of the holiday there at that time. Well, then you sort of can say, well, if you invest your retirement savings in cash, you are certain or near certain to not achieve your retirement goal. If you put it in a higher balanced portfolio, then this is the range of outcomes it's more likely you'll achieve because we expect to get higher expected returns as a result. There's a variability of outcome. There's ups and downs, but our view is that these things level out a little bit over time, and this is your range of outcomes. So it can't just be about, the challenge for advisors is to have the technical skill and the tools in support to really be able to frame, do the grunt work behind the scenes, but then that communication challenge to sort of say, well, this is what it's going to look like for you. It's not assured that you're going to achieve your goal, but we're giving you this, we're putting in place something that has this range of outcomes to achieve that goal, and we think that's the right range of outcomes for you. The other thing I just throw in is that, goals-based financial planning starts to feel more like a partnership because, you have your financial assets working for you, but there's also this opportunity to, maybe save a bit harder if things aren't going well, and and having that sort of engagement that you can have between the advisor and the client. So there's much more of a partnership model with a shared goal that's coming through.
Yeah, I visualize that when I say that when you say that as a target on an XY axis. So you got time and money on the axis, and you're going to end up with a low or a high or an early or a late, depending on where it is, rather than an exact number at exact time. Dan?
I love that you brought in the word stochastic and because the linear modelling that tools that have been made available to advisors. I mean, it's the industry's fault that advisors have had to use these sorts of tools where providing it in a stochastic modelling system to show variability, you can have far more meaningful conversations with clients where you say, okay, well, you might want to invest your money in this way, but there's a 90% chance that you'll run out of dough by the time you're 70. Like, are you comfortable with that? We can increase the variability of the outcomes, but the probability of you achieving, whatever this goal may be, or, this financial amount of money that you need could be, greatly expanded. And then the ups and downs of the market become hopefully less relevant, and it's more about let's understand the variability of the outcome, i.e. the risk associated with the outcome, and how comfortable you are with it. And it's I think the real value is not just in the initial conversation and setting that up with the client, it's the ongoing conversation, which you mentioned, David. I think that's where, you can come back and say, like, are we on track? And, what has changed? And are we ahead of schedule, or are we behind schedule? And what can we do to change it to make sure that we're on track? I think it's that ongoing review piece becomes even more valuable. I think it first of all, it creates a fantastic first interview with the client, but the ongoing engagement is just so much more powerful, I believe.
Yep. Now, we're talking about projections here. We're talking about the tracking, which is amazing. I love this conversation. And we're talking about staying inside the tracks. Now, for those listeners that this stochastic modelling versus deterministic modelling, essentially deterministic is your basic spreadsheet. Think about that. You put the number in, you put the return in, it does the same return every year. But stochastic is talking about adding some variables, and it could be up this year, it could be down this year, and that's going to have a big determination on what it might be in 20 years from now. Gentlemen, thank you so much for coming on and talking about this particular episode. We're talking about goals-based investing. The next episode, we're going to start talking a bit more about values-based decision-making, which we're going to put these two together, basically the biases we came from the first conversation and the goals-based investing, and start talking about values-based decision-making. We look forward to catching you in the next episode.
Thank you.
Cheers, Fraser.